Hello and welcome to a special interview. Now, the stock price of Yes Bank of late has been on the receiving end of the market fury. Some investors are nervous, some investors are curious, but in general, everybody really wants to know that in this kind of an environment, where is Yes Bank going as a bank? And given the macro and the positioning of what the liquidity crunch, both local and global, has been, what is the way forward for Yes Bank and the entire NPL cycle? So, to clear the air, to answer some tough questions and to give us a better understanding of the latest development in Yes Bank, we have with us Mr. Ravneet Gill. Mr. Gill, thank you for joining us.
Pleasure.
The stock is down from 400 rupees to about 110, 115 rupees. And the price action is telling you that there is anxiousness and there is anxiety. What is making markets nervous?
So I think more than nervous, I think there may be a certain degree of uncertainty, Nikunj, and I think that uncertainty stems from three factors as I see it. The first and foremost is that there's been a lot of speculation with respect to the board, given the fact that two of our directors had resigned recently. The second aspect is with respect to asset quality, and within asset quality, within the NBFC sector per se. And the third one really is with regard to our capital raise. So I would say that these are three big buckets if you had to identify factors which have led to a little bit of uncertainty and which has obviously impacted the share price. That these are the three factors which are currently an overhang. And I think it's very important to be able to understand what the underlyings for each of the three are.
So let's do that. First, let's talk about the board, because that's something which is the latest development in terms of the corporate news.
Yes.
The way markets perceive sudden resignation of board members is that there is something which the board members know and they are not accepting it.
Right.
Why have the board members resigned?
Yeah. So I think there was some media speculation around that. What I would say is that the two resignations that happened, both regretted resignations, is that they just seem to converge from a timing perspective. As you've seen, both the directors did say that they were doing it for personal reasons, and which is also the fact that they were doing it for personal reasons. One of them actually wanted to step down earlier as well, but was told that, look, there's been a management transition, so stay in there and help with the management transition, which was done. Now I've been here for over 3 months. And then, like I said, because of the timing, it appeared that it was something which either got orchestrated or came on the back of some events. All I will say is that it was just coincidental that both resigned at the same time. But as far as the board itself is concerned, what I would like to assure, the markets, stakeholders, and other investors, etc., is that the board is completely united. Yesterday we had a board meeting before and post the AGM. It was a very productive, very constructive meeting. And anybody who's saying that there were divisions within the board or that the board is in a meltdown phase is completely wrong.
But facts, you think it's too much of a coincidence that two board members have suddenly resigned after you took over?
So I took over 3 months back. Yeah. So this happened now, and like I said, that it's just a matter of coincidence, the timing that the two of them decide to go at the same time.
Okay, Mr. Gandhi is now on the board.
Yes,
and that is something which, in a sense, is going to be. I mean, I think markets should also realize that Mr. Gandhi is coming on the board is a clear indication that there is a former RBI deputy governor who knows what's happening in the bank now.
Yes,
you think one must not undermine the importance of that?
I think, forget undermining, I think, one needs to fully appreciate actually the importance of having RBI appointed additional director on the board. It should give the markets a lot of confidence. I mean, if anybody thought there was a certain amount of opacity around facts, or there was something that was happening which was not right, then that gets addressed by the presence of the additional director appointed by Reserve Bank of India. So for the board meeting that we had yesterday, Mr. Gandhi attended in person. He was there. He observed everything, the way business, etc., got transacted. Obviously, contributed a lot given his experience as Deputy Governor DBR and his standing in the financial services business. So I said this earlier at the time of his appointment, and I'll just repeat that it's a very positive development as far as the bank and the board are concerned. And yesterday he was there, fully engaged, participated well, and like I said, that we had a very, very engaged, constructive and a productive board meeting yesterday actually, Nikunj.
Anything in the AGM which we should know, because there's a lot of speculation, sir, and you are in the perfect position to clear the air. Why don't you use this forum to clear all the air? You'll appreciate that there is a lot of social media angle and all kind of opinions float around.
Right.
We were not part of the AGM.
Yeah.
We are picking up through sources, but what happened there?
So I think yesterday the AGM, as far as the AGM is concerned, it was my first AGM. But what I heard from some of the other board members was that it was very well conducted. The questions that came, a lot of the observations that were made by shareholders, you were very, very constructive, very informed. It was conducted in a very orderly fashion, for which obviously I need to thank the shareholders. Each of them, when they came and spoke, also talked about the fact that these are difficult times for financial services in India. We've had issues with respect to asset quality issues, the industry per se, but each of them reposed their faith. And if you see the way our resolutions were passed, shows how strongly the shareholders stood behind the bank. So I would say that there was nothing at all untoward which happened in yesterday's AGM. Or some observations that were made or concerns that were expressed that should be a matter of either a speculation or a concern whatsoever.
We've not picked up anything. I mean, I would have imagined that when you see such a sharp drop in a stock performance, the retail shareholder, normally they tend to get anxious.
Yes.
But, frankly, I can speak on behalf of my channel that we have not really picked up any speculative fervor and anxiety from some people who've attended the AGM. So I think the AGM was very well conducted.
It was well conducted, but like I said, that credit to our investors and our shareholders who were there, who came and obviously did express some concern with respect to the share price having come off, but equally felt totally confident that we will rebound very quickly, and the fact that they stood behind the bank. It is interesting actually that many of them suggested that if you're looking to raise capital, why don't you do a rights issue, and each of us will come and participate in that.
Oh, you actually got that sense.
So and it didn't come from one or two shareholders; it came from multiple shareholders. So as a matter of fact, I mean that was again very gratifying to see that how much goodwill the bank enjoys with the shareholders.
That's very reassuring. Okay, the second point which you said is that what happens to your loan book?
Yes.
Now, along with your numbers, when you came and declared, and you really in a sense were very honest in admitting that, look, I've got a problem, I'm making a watch list, there is a problem which I'm admitting, but this is the high watermark beyond which I would not go.
Yes.
So if I revisit your credit guidance was a slippage of 200 to 250, your slippage which you've given. There's a UBS report which says that there is going to be a significantly higher change in management guidance of slippage by 125 to 150 bips.
So I don't know where this has come from. I mean, without wanting to get into details of that, I think that, some discussion should have happened with management before numbers like these get put out. So to that extent, I feel disappointed. When we had our fourth quarter results, we clearly said that for the current year, our credit cost guidance was going to be 205 basis points. Yeah. Out of which 80 basis points was subsumed in quarter 4 by way of the contingency provisions, and that for the remainder of the year, our credit cost guidance was 125 basis points. I'm saying this again, that nothing has changed. I'm not changing the guidance by a single basis points. We stick to the fact that in this year, our credit cost will not exceed 125 basis points. So let's put that matter to rest once and for all.
But the scenario, Mr. Gill, when you communicated this guidance along with your numbers versus today, the scenario really has not improved. If you really think about the general lay of the land,
yes.
slowdown in terms of demand, in terms of whether, high frequency data points, the liquidity in the system, the macro hasn't improved.
So the interesting thing to note over here is that, and I had made that point at that stage itself, that the book that you put out there, which was our sub-investment grade book, and then a subset of that was the watch list, was not a very granular book. It wasn't as if that there was a general migration of a portfolio to sub-investment grade. I mean, these were just a few concentrated names which were experiencing illiquidity at that point in time. And if I look at it from that standpoint, in each of those names, we've had progress since the time that we had our year-end results in terms of either asset sales, change in shareholding, and in some cases, change of control. So either that has happened in certain cases or is now on the cusp of happening. And the good thing about, having just a few concentrated names is that just as they can come and, cast a cloud over you in terms of magnitude, when the resolution happens, that resolution also happens very quickly. And the mood and the sentiment can change very quickly around that, given the fact that it's just a handful of names.
Okay. Now the names are out in the public. I'll leave the option to you whether we want to discuss individual names or not, but just for the benefit of our viewers, Dewan Housing, ADA group of companies, SL group of companies. Have you got any sense from your current borrowers that they are on course to really not default and repay their obligations?
So the point I made with respect to actual progress has happened either in terms of a stake sale or in terms of change in shareholding, change in ownership. It's happening to this very portfolio. Okay. It won't be right for me to get into specifics with regard to any of these names, But what I will say is that from the time that you provided a credit cost guidance to now, there has actually been very tangible progress in the entire sub-investment grade book that we had talked about.
Okay. So I don't want to get this one wrong. Please feel free to correct this one. I'm choosing my words carefully. What you're telling us and what you're telling our viewers is that you're not confident, but you are certain
Yes.
that there will be no more slippage in your current guidance, irrespective of whatever happens.
I'm still saying that I'm drawing a line under the guidance that I provided, the credit cost guidance that I provided during our year-end results. Nothing has changed from that.
In financial markets, they say never. What is the risk?
Look, you asked me that, what is my current sense of conviction with regard to the guidance that we provided. And I'm saying that I'm more convinced than ever that the guidance that we provided, we'll stay within that.
In hindsight, the whole watch list, now some would argue that, look, you wanted to be frank, open and transparent. Markets have not received that well. In hindsight, do you think that was a mistake?
It wasn't a mistake. I think if you see why this is coming is that they have seen this happen in the case of two other banks, where a watch list was provided and then that watch list continued to grow over subsequent quarters. Do remember that in those cases, what happened was a certain cyclical bind that they got into, which was the cement steel power thing, and which, given the fact that it was cyclical and it had to do with sectors, that unless the sector came out of the problem, I mean, your portfolios could not be remedied. For us, it's not a question of cyclicality. It's not a question of being caught in a particular sector or an industry. What we are saying is that this is just a bunch of names which have all at the same time experienced a little bit of illiquidity subsequent to the events that happened in September. And to that extent, the coming out of that doesn't have to be protracted. We are not dependent on external factors, either in terms of regulation, in terms of industry dynamics, for us to be able to come out of that. So the reason that the market has a sense or took this with a pinch of salt, if I can say that, is because they have seen this happen in
once bitten, twice shy.
Twice shy, but the context in the two is dramatically different.
Fair point. That's a great explanation. You would have seen what rating agencies are indicating.
Yes.
They've not cut the guide. They've not cut their rating, but
yes,
they are indicating that it is for review.
Yes.
And the reasoning why they are communicating to us is that the rating of Yes Bank could be for review is because they think that there could be an issue with asset liability and also in terms of some of the loan repayments. So can we go back to that same point and say that they are
so when the some of the rating agencies spoke with us, one of the concerns that they expressed was about the NBFC sector. Now, the point I would like to make right now is that if I look at my NBFC exposure, all of it is current as we speak right now. But there have been certain NBFCs that have got downgraded, and obviously when you get downgraded, there's always a concern with respect to what could happen. And there is enough happening in those companies for us to know exactly how they're remedying the situation, whether it's in terms of recapitalization, whether it's in terms of M&A, whether it's in terms of strategic stake sales. So we feel comfortable on that. So first and foremost was some concern that how does that sector pan out vis-a-vis us, and then the second one was the timing of the capital raise. And the reason it has been put on review is that they would like to see some resolution happen on both these fronts. For them to be able to take a call, that's it. And if the concerns were more fundamental, I think it would have, the consequences could have been more severe.
Another challenge some analysts have argued is that you got a large exposure to promoter funding.
Which again is not correct.
That's a belief.
Yeah.
That's why I wanted to speak the numbers.
I think what that exposure is captured adequately in the guidance that we provided.
Okay, great. So you've looked at all the nuances before you've given this guidance.
Of course.
So you've basically what you're telling us is that you've run the model with the worst case scenario and then you've given a guidance.
Exactly.
This is not an optimistic guidance.
No, not at all.
I'm archiving your statements.
Absolutely.
Okay. Now, markets, they always focus on where the puck not where the puck has moved, where the puck would move.
Right.
We've discovered yesterday, we've discussed today. Let's discuss tomorrow.
Yes.
Now, banks in the business of lending.
Yes.
Given that there is a slowdown in the industry, given that the capital is not freely available for Yes Bank now, what happens to your growth?
So, I will like to challenge what you said that capital is not freely available for Yes Bank, and we can talk about that. The other thing is that you always have the ability for portfolio optimization in terms of being able to churn assets which you think are not really value accretive, or if you think that there are opportunities to grow where the returns are better, then you'll be able to substitute those assets with that. That's something that is being done in a very dynamic, intense fashion as we speak. So we're making sure that there is enough portfolio intensity and that we continue to grow and be able to generate revenues. Obviously, once capital comes in, that growth will go up. And to come back to the point that you said that there is a challenge around capital, I'm not sure I agree with that, Nikunj.
Now, the view in the market is that you will not like to raise capital at this kind of a price to book. Is that true?
No, I think we haven't really focused on that. At the end of the day, while at what price you dilute is always a consideration that which needs to be taken into account. At the same time, right now we need to think what does the bank need, and if at this point in time we need capital, then I'm sure that we are very clear in our minds that we will go ahead and raise capital.
Markets are talking about the fact that you're talking to a private equity player. Is that true?
So I don't think it's true that we're talking to a private equity player. I think there is a lot of interest from private equity players in terms of the investment in Yes Bank, and some conversations are currently underway.
So what stops you from getting a private equity player? If you get a formidable, well pedigree PE player, that's just going to be endorsement of your books, endorsement of your thought, endorsement of your views, and endorsement that money has come back. What is stopping you? Because if you are in conversation or in advanced negotiation with a bunch of PE players, I mean, this should be Beethoven and Mozart to an investor's ear.
It should be, and it will be. I just think it's a question of assessing all our options with respect to a public markets transaction vis-a-vis private equity, and what the right timing around that should be. But like I said, that you rightly put it, that this should be music to the ears of an investor, and I'm very hopeful that our shareholders should be able to hear that music sooner than later.
How will second half be different from the first half?
I think more focus on growth. I think as we moved into the year end, there was the period of consolidation, controls, governance, looking at risk management, etc. But once capital comes in, I think our focus will go straight back into being very, very growth oriented, and I actually think that the prospects for the rest of the year should be very strong.
So if I have to, let's say, chart perhaps a trajectory for Yes Bank, can I say that 2019 or FY20 will be the year of repair and 2021 will be the year of comeback?
So I think the repair and comeback, I mean, I don't think there's a comeback that is needed. I think we didn't go anywhere that we need to come back. I think both from the point of view of repair and growth, these are levels which management needs to be able to operate simultaneously. So it's not as if that this has to go in a modular fashion, that first you do this and then you do something else.